Welcome back to Investing Talk podcast. We are looking today at a really significant player in healthcare, Abbott Laboratories. They've got their Q3 2025 earnings report coming up, and it looks critical. Yeah, we got a bunch of sources here, and honestly, they're showing some fascinating, almost conflicting signals. You've got these conservative analyst views on one side,
and then pretty bullish management confidence on the other. So our goal today is really to synthesize all that. Try to pull out the core drivers for the stock.
Exactly. Before we dive in, though, just a quick reminder, please hit that subscribe button if you haven't already. Maybe give us a like, and definitely drop your thoughts in the comments below. And hey, if there's a specific company you want us to analyze in the future, let us know down there, too. Just put the ticker in the comments.
Right. So our mission here is pretty straightforward. We're distilling these pre-earnings sources to hopefully give you a bit of a strategic edge. We want to cut through some of the noise, give you a clear view of the key risks, what the expectations really are, and maybe most importantly, the potential catalysts that could actually move Abbott Labs when they report.
So you walk away understanding the story behind the numbers.
That's the idea.
Okay, let's get into this setup then. We're talking about the Q3 2025 report, which covers the quarter ending September 30th. And the date for the call, mark your calendars, October 15th, 2025. It's early, 8:30 a.m. Eastern Time.
Right. And, when you first glance at the official analyst consensus, it feels, almost deliberately cautious, especially for a company this size. The revenue expectation, it's sitting right around $10.23 billion.
Okay, $10.23 billion. And what's the context there?
Well, here's the thing. That consensus number, it actually implies a slight decline, about 1% year over year.
Wow. Okay. A projected decline, even a small one, definitely sets a low bar. What about on the profit side, EPS?
Yeah, the non-GAAP earnings per share consensus is $1.15.
Oh, 15.
Which, again, suggests a drop about 3% compared to last year. Now, there's always the whisper number, right? What traders might be thinking internally. That usually sits a little bit higher. Maybe $1.18 non-GAAP EPS in this case. So you could say there's an expectation of a tiny beat already baked into the price.
Okay, but this is where it gets really interesting, right? And this is probably the most crucial point for you, the listener, to really grab onto. We have this cautious street view, the $1.15. But our sources are pointing to a massive difference compared to the company's own guidance. It's a real disconnect.
It is. It's basically the core of the trading story right now. Management is singing a completely different tune. If you look back at their Q1 guidance earlier in the year, they reaffirmed a full-year non-GAAP EPS range of $4.55 to $4.07, which was already pretty decent.
Right, but that got updated, didn't it? Yeah. Especially after that really strong Q2 they had, 0.26 EPS, revenue over $11 billion.
Exactly. They crushed it in Q2. And afterwards, they didn't just stick to their forecast. They reaffirmed an even higher set of numbers. They raised the stakes.
So what's the new guidance?
Their updated Q3 guidance is actually between $1.28 and $1.32 per share.
Whoa, wait. $1.28 to $1.32.
Yep. And the full year guide jumped way up to $5.10 to $5.20.
Okay, I have to stop you there. How can the official analyst consensus be sitting way down at $1.15 when the company itself, the people who should know best, are guiding to $1.28 at the low end? That's, nearly 12% higher? What gives? Why are analysts so skeptical?
That gap is the critical friction point. You nailed it. Analysts are likely hedging. Probably because of two things we'll touch on more. One is seasonality Q3 can be weaker, but maybe more importantly, it's that continuous, drag from COVID diagnostic sales dropping off. It's been huge.
Oh, okay.
So analysts are essentially saying, look, we hear management's confidence, but we're not totally convinced that core business growth can fully offset that COVID cliff just yet. Show us the proof.
So the real test isn't just beating $1.15. I mean, that seems almost guaranteed if they're profitable at all. The real question is, can they get anywhere close to their own guidance? That $1.28 plus number.
Precisely. That's the benchmark that matters. It's like the analysts are predicting a 4-hour marathon, but the runner, management in this case, just confirmed they trained for a sub-3-hour finish.
Right.
Beating the 4-hour mark isn't the point. Hitting that internal 3-hour target, that's the real measure of success here.
Okay, so let's look back a bit. Abbott Labs generally does beat estimates, right? Yep. Usually by a small margin. But the sources say those beats don't always lead to the stock going up. Why is that?
That's absolutely right. And it really hammers home the point that it's the forward guidance, not just a reported quarter, that tends to drive the stock price immediately after earnings. Abbott has, generally provided small upside surprises, both revenue and EPS, I think, in 3 of the last 4 quarters. They're consistent, sure, but the beats are usually pretty marginal.
But if they keep beating, even by a little, why wouldn't the stock get rewarded? You mentioned sometimes a beat led to the stock actually dropping the next day.
Yeah, it seems counterintuitive, but it boils down to expectations being forward-looking. The market knows these things. We saw those post-earnings reactions were all over the place, sometimes down 2%, sometimes up maybe 1.3%. Pretty mixed. That volatility sort of confirms the market is discounting that whole COVID bump still. The small beats are seen more as, well, confirmation the business isn't falling apart. But the market's holding its breath, waiting for proof that Abbott can actually hit that next level that much higher, $5.10 plus full-year guidance. They want sustained core growth.
Okay, so finding that core growth. We need to break down the business segments, see where the actual strength is. Looking back at Q1, which kind of sets the stage, where was the momentum?
Well, the strength was really focused in a couple of key areas. First, medical devices. That segment showed incredibly strong growth, organic sales, up almost 9%, like 8.9% year over year.
Okay, hang on. Organic sales. Can we just quickly clarify why that specific metric is so important right now, especially for Abbott?
Yeah, good question. Organic growth is vital because it strips out things like currency swings, which can really distort the picture, especially for a global company. And it also removes the impact of, say, small acquisitions. So when we talk about 8.9% organic growth, we're seeing what the core underlying business is actually doing. It's a cleaner measure of operational performance.
Gotcha. Okay, so medical devices robust at 8.9% organic. What else was working?
Established pharma was also very strong, up 9.7% organically. Nutrition was solid too, moderate growth, about 6.1%. Now, the flip side, of course, is diagnostics.
Which is where all that analyst worry seems to be centered.
Exactly. Diagnostics reported an overall decline of 4.8%. Almost entirely because COVID testing sales are falling off, as expected. However, and this is the number the street will be watching like a hawk this quarter if you take out those COVID sales, the rest of the diagnostics business actually showed slight organic growth, 0.5%.
Okay, so positive, but just barely.
It's just barely. That ex-COVID number really needs to pick up speed if Abbott wants to bridge that gap between the analysts and their own higher targets.
Right, so the story is basically strong medical devices and pharma trying to make up for the diagnostics drag.
Yeah.
But management clearly thinks medical devices are accelerating enough.
Yeah.
Was there any news during the quarter that backs up that strength?
Oh, yeah, definitely. And these are the catalysts that probably give management that confidence you mentioned. Two big operational wins happened right around the start of the quarter that are really relevant for medical devices, especially structural heart and diabetes care.
Okay, lay them out for us.
So first, back in July, they got a key FDA approval for a new version of their MitraClip device. That's a big product for their structural heart business.
Right, high margin area.
Very high margin, very innovative. And second, maybe even more significant for future growth, was that partnership they announced in September with Dexcom.
Ah, yes, the glucose monitoring deal.
Yep.
Integrating CGMs and insulin patches.
That's the one. It links Abbott's super successful CGM, the Libre, with Dexcom's tech. It really cements Abbott's position in diabetes care, a huge market. And it provides a clear path for, keeping that momentum going in medical devices, their strongest segment. These are concrete wins that support that ambitious guidance. Now, before we talk about this stock chart, we should probably circle back to seasonality for a second, because it really does feed into why analysts might be so cautious. Q3, the summer and early fall period, it's generally just a seasonally weaker quarter for big healthcare companies like this. Hospital budget cycles, different diagnostic testing patterns.
Fewer procedures, maybe.
Could be part of it. That seasonal headwind just makes any growth seem a bit harder to achieve.
And that underlying weakness seems reflected in the estimate revisions we've seen lately, too.
It is, yeah. Over the last 3 months, analysts have actually nudged down both their EPS and revenue estimates slightly. EPS down about 0.7%, revenue down 0.2%. It's not huge, but it confirms that cautious mood feeding into that $1.15 consensus.
Okay, and looking at the stock price itself, technically it seems pretty stable recently. It's been stuck in a fairly tight range, hasn't it? Like $102 to $112 over the past, 5 weeks or so, trading around $108.50 right now.
Yeah, quite tight.
So given all this, the caution, the guidance gap, the tight range,
Yeah.
what's the options market saying? What kind of move is expected after the report?
Well, the market is definitely bracing for some kind of reaction. If you look at implied volatility, the sources put the IV rank at 62%.
62% IV rank. What does that mean in plain English?
It basically means the options market is pricing in more expected volatility right now than it has for roughly 2/3 of the past year. So yeah, it's elevated. People expect to move.
Okay, so how big a move?
Yeah.
How does that translate into, dollars and cents on the day after earnings?
The pricing suggests the market expects a move of about plus or minus $4.30.
$4.30 on 108 minute cents, that's around 4%.
Roughly 4%, yeah. Either way, up or down. Which, for a giant stable company like Abbott, that's a noticeable swing. The market senses that something has to give with that big disconnect we talked about.
Which brings us right to the scenarios. What are the likely outcomes here? Let's try to break down maybe 3 possibilities, linking them back to the business segments.
Okay, so we'd probably assign the highest chance, say about 60% probability, to the base case. This is basically inline results. EPS lands somewhere between maybe $1.13 and $1.16. Close to that consensus, maybe a tiny beat.
And what drives that?
Driven by pretty much steady average growth in medical devices, just about offsetting the slow recovery in diagnostics. If that happens, the stock reaction is likely pretty muted, neutral, maybe plus or minus 3%. Kind of confirms the status quo.
Okay, the middle ground, what about the upside? What triggers the bullish case?
We'd put that maybe around a 25% probability. This needs a real acceleration, especially in that core medical device business. Driven by Libra sales really humming, structural heart doing well. If they hit, say, $1.18 up to $1.22 on EPS, getting towards that whisper number or better.
And crucially,
if management comes out and strongly reaffirms or maybe even slightly raises that high full-year guidance, that could trigger a strong move, maybe plus 5%, plus 8%. That would be the market finally buying into the company's own ambitious story.
right, believing the guidance. And the downside, the bearish case.
That feels like the lowest probability, maybe 15%. This would involve a real disappointment. Perhaps unexpected margin pressure, maybe supply chain costs, labor costs, something bites harder than expected. Or maybe that diagnostic segment, even ex-COVID, just completely stalls out or goes backwards. If EPS drops down into the $1.08 to $1.12 range, yeah, the stock would likely sell off hard as confidence in that high management guidance evaporates. You could see a drop of maybe negative 4% to negative 6%, possibly more. Hashtag outro. So, wrapping it all up, synthesizing the analysis, the foundation seems pretty solid, right? You've got strong pipeline execution, that MetroClip approval, the Dexcom partnership we mentioned, and management is showing, well, a lot of confidence by sticking to that really high guidance range, the $1.28 to $1.32 for Q3.
Right.
So, while we definitely acknowledge the cautious analyst view, the seasonal factors, our overall leaning is probably neutral, but definitely with a slight bullish skew, given management's conviction.
And you mentioned specific metrics earlier. If someone's watching the report come out live, what are the absolute key numbers they should focus on?
Yeah, I think 2 things jump out. First, that organic growth rate in medical devices. Need to see if those catalysts are really translating into accelerating growth. And second, the organic growth for diagnostics, excluding COVID. That's the number that needs to show real improvement to prove the core diagnostics business has truly turned the corner and is recovering.
Makes sense. And looking beyond just this quarter's numbers, we did see some notes in the sources about longer-term factors that keep people interested in Abbott, kind of regardless of the quarterly bumps.
That's right. The longer-term story has a couple of anchors. First, there are always these kind of persistent low-level rumors about potential M&A, usually small bolt-on deals maybe.
What areas?
Speculation usually centers on expanding their footprint in faster-growing areas like maybe digital health tech or specific diagnostics technologies. Nothing concrete, but it's out there.
And the other piece,
Yeah.
especially for income investors.
Yes, the dividend. Abbott has a strong history there. And given their, fairly conservative payout ratio and really predictable cash flow, there's a pretty decent chance of a significant dividend hike coming, maybe in 2026.
Okay.
So those longer-term things, potential M&A, the dividend growth story, that's part of why the stock often finds support. It provides a bit of a fundamental floor, even if Q3 gets a little messy. Definitely something for you to keep mulling over as you look at their results next week.